Welcome everyone. Let's get started. Okay, your homework assignment that's due on Tuesday includes some topics that we're going to talk about today, the minimum attractive rate of return, MARR. And in general, I'm going to do my best so that what you do on the homework is things that we've covered in class through an in-class exercise, or at the very least through like an illustration, example. But there may be a couple of times through the semester where there's a homework problem that's completely unfamiliar to you. And so in cases like that, what you should do is look through the textbook and see if there's an example that addresses the concept. And when you graduate and become a practicing engineer, the vast majority of things that you're assigned to do will be completely unfamiliar to you, at least the first time that you do them. And so we're trying to ease you into the idea of being self-directed learners, where you have some tools and some resources and have to figure out on your own how to solve the problem. So it shouldn't come up too often, but just to give you as a warning that there may be a couple of problems through the semester that you're on your own. And of course, not really, because you're always welcome to stop by my office during office hours or send me an email and I'll do my best to respond. You can collaborate with your classmates as long as it's not the inappropriate collaboration. So, homework assignment is due on Tuesday, and then on Thursday we're going to have our first quiz of the semester. There aren't any equations you need to memorize for that first quiz. I haven't written it yet, but I anticipate it'll be a blend of both conceptual questions and problem solving. So conceptual question may be where I give you a term and you have to explain what that term means. Or it may be that I show you a picture and you explain the picture and the concepts that it represents. And so that's a conceptual question, and then problem solving, that's self-explanatory. It's just calculations and finding the answer to some question. So we'll have that quiz on Thursday. Any questions related to these announcements before we start on the new material? Yes? Do you have the book with you? Because I don't remember exactly which problem you mean. Oh, is it one that I've written? Yeah. All right, so you're asking about which problem? Okay. Problem 4 is compounded each year, and the same is true on problem 5. Both of those are annual compounding. Thank you. Simple interest is pretty unusual, and so the default assumption is that when percentage interest rates expressed as a percentage, those means per year, and the default assumption is annual compounding, unless it says monthly, quarterly, or if it says simple interest. And so unless otherwise noted, you can assume annual compounding. Thank you for asking that. Other questions? All right. We're going to start by looking at this picture. And this is the first time I've broken apart the image into two components. If you've printed off the notes, maybe you see something different than starting with this. But I think looking at the image in two parts will make it a little bit easier to understand. And so this first one, the blue line represents the interest rate that a company or an individual would have to pay as a function of how much money they're borrowing. And so let's dig into that. On the horizontal axis is the cumulative amount of money that's been borrowed. And you can see each one of these is $1 million. 1 million, 2 million, 3 million. On the vertical axis, it's the annual percentage rate that you're paying on the money that's being borrowed. And so there's a trend here. It looks like at first the trend is relatively flat, that it costs the same interest rate to borrow $1 million as it does to borrow $2 million. That whoever it is that's borrowing this money, that the bank will give them 10% rate whether they borrow 1 or 2 million. But then if you look at 3 million, suddenly it seems like the slope of this line is increasing a bit, where they have to pay slightly higher interest rate for 3 million than they did for the previous amounts, and then it's only getting worse from there. The line is getting a bit steeper, so that if they wanted to borrow $7 million, now they're paying 15% interest instead of 10% when they only borrowed $1 million. So there's a lot of possible explanations for this, but what do you think is one of the most likely reasons why the percentage rate is going up depending on how much money this company wants to borrow from the bank. What's that? It's actually not inflation in this case. That's a good guess, but that's not this one. Okay? Okay? So you mentioned risk, and that's a really important one. Is that what you were also going to address, is the amount of risk? All right, so think of it this way. Let's say my company has been in business a few years. It's a construction company. It's fairly well known. You know, I'm doing maybe $2 million worth of business every year. And so the banks know what my company is capable of. And they look at my history, they look at the projects I have in the pipeline, what I'm doing, my employees, and they say, well, to borrow $2 million, that's not too much of a risk. Of course, the bank wants to repay, they want to be rewarded for their investment, and so they're not going to loan the money for free. They're wanting some profit. But when they look at my company and my history, they're a little bit more nervous when all of a sudden I tell them I want $7 million. So now what the bank is doing is they're thinking, well, there's a greater potential that this investor won't be able to pay back the loan. You know, they're thinking that maybe I'm borrowing all this money to buy new equipment, maybe I'm buying some construction equipment, and maybe they're worried I'm not going to be able to use all the equipment that I'm borrowing. And so for them, in their view, it becomes more risky, the amount of money I want to borrow. There are ways that they can overcome that risk. They can buy insurance. Like banks can buy insurance so that if I don't pay, then someone else will pay the bank. That's called default insurance. And that's actually one of the things that caused the big financial crisis back in 2008 is lots of companies were buying insurance for defaults, and they didn't even they didn't own the loan to begin with. It was just a way of gambling. Like someone would say, I think that bank maybe is going to default, so I'm going to buy insurance, and if they go bankrupt, I get paid, even though that person had no interest in the bank. It was just a way of them gambling on the market. So, you know, that's a tangent. Let's not get too deep into that. But this trend makes sense to everyone, right? The more you borrow, the bank wants a greater return, partly because of the risk, but then there's also another factor as well. If the bank gives you $7 million, they can't give that same $7 million to someone else. I mean, that's obvious, right? You can't give one amount of money to two different people at the same time. And so they're losing the opportunity to put it somewhere else. And so the bank is worried, well, what if I could have taken this money and given it to someone who is going to pay me a higher interest rate? And so they're always thinking about, there's an old saying that the grass is always greener on the other side of the fence. Like if you look at your neighbor's lawn, it seems like maybe your neighbor has things better than you. And so the bank is thinking, well, if I give the money to one investor, then I won't be able to get to someone else. Okay, so this is the trend that's going to be behind a lot of other data. I'm going to switch slides in just a moment. The axes mean the same thing. The blue line means the same thing. It's going to be a little bit more cluttered. Okay, so, yeah.
So the reason was increased risk?
Increased risk and also opportunity cost. Risk of default. Default means someone's not paying back their debt. Risk of default and opportunity cost, meaning the money that the bank gives you, they can't give to someone else, and maybe someone else would give them a better return. So they have to cover their bases. Okay. So here's that secondary image. The axes mean the same thing. Cumulative investment amount. You'll notice that before I just had it saying cumulative amount. It's the same thing. Cumulative investment amount means I'm a company, I want to start lots of different projects. I'm going to buy new construction equipment, I'm going to buy new computers, I'm going to invest in training for my employees, maybe I'm going to start doing advertising. For any company, there's so many different things you can do to build your business. And that's what each one of these boxes represents, is some other opportunity. Maybe A is training the employees to be more safe so that I don't have to pay so much for injuries. Maybe B is a new computer system that allows me to manage my time better. Maybe C is a new bulldozer for earth-moving equipment. So it doesn't matter what these things are. You can imagine lots of different possibilities, but you'll notice that they're ordered so that the first one is giving me the best return. So on the axis here, it says annual rate of profit. So if I do project A, remember project A was that safety training? If I spend $600,000, which is the width of that line, if I spend $600,000, then it's sort of like I took that money and I put it in a bank account. Because all of a sudden the employees are going to be getting hurt less, and so they're more productive. And so the rate of return on that investment for me is 35%. Now I'm not actually putting it into a bank that gives me 35%. It's just the investment will yield more revenue in the future. And this is an estimate. I estimate that that revenue in the future is going to be worth 35%. Project B, whatever it is Project B is, we can see how much it costs by how wide the line is. And so how much does Project B cost? Roughly. So here's 1 million, and then maybe here is approximately 400,000. So it looks like it's about 1.4 million. Okay, so the width of B tells me the cost of it, and what is the rate of return on that investment? 30%, right. Now let me ask you something. If I had to borrow money from the bank to finance those two investments, let's say I don't have the money for the safety training, I don't have the money for the new computer system, I have to borrow the money from the bank. Should I do that? Why? All right, I see people saying there's more than, there's less than. Yeah, of course. If you can borrow some money from someone at 10%, and then you spend that money on something that's going to return 35%, you give the 10 to the bank, and you keep the 25% for yourself. And so that's an excellent investment. Anytime someone will loan you money less than you can turn a profit, you should always do it, as long as the profit is guaranteed. But even if it's not exactly 35%, let's say that was too optimistic. What if I only get 30%? Still a profit, right? So there's some uncertainty, but it seems like option A, we should absolutely do option A. We should do option B as well, because the same rule is true. I will get 30%, and I only have to pay the bank 10% for that money that I borrowed. All of a sudden, if we follow this to the right, to the limit, our borrowing costs are going up, and I've organized this list of projects so my rates of return are going in descending order. And the reason I put it in descending order is it helps me to know my list of priorities. You should start with the project that gives you the most money. Do option A first, because it's the one that has the highest rate of return. If I'm only allowed to do one project, I want to be identifying the one that will give me the most profit. But I can do more than one project. The minimum attractive rate of return in this case, I wouldn't do project F. You can notice that it's shaded and it says reject F, reject G. Who can explain why we reject those two projects? Right. So for F and G, my borrowing costs were higher than my rate of return. So that is not acceptable. I don't want to be borrowing money at 16, 17% and then only receive back 14% for project G. Ah, okay. She's making a good point. She's saying, well, what if we did F first? If F had been first, then 16 is greater than 10, right? That's true, but if we had done F first instead of A, then what we're doing is we're doing a project with 16% interest before a project with 35% interest. And so I'm glad you asked that because it's an important point. Whether or not to do project F depends on how flat this borrowing curve is. And it also depends on the number of good projects. Let's say that I still do A and B, but what if all of a sudden the law changed and whatever it was I was going to do for project C, let's say that now it's illegal. Can't do it anymore. It's not available. That would shift all of these projects to the left, and I think these rates of return would be above the line if project C was no longer available. They're only rejected because at that point we have other things we'd rather do before project F and G. Does everyone understand what I'm saying about what if project C didn't exist? Do you have a question?
What if it was you had this like top if you're on all of them, then you could include all the projects instead of just for
But not really though, because you'd have to look at the total amount of money that's required to do all of them, and even if we reordered it, the total amount of money that we'd need would be below the curve. And I know that it looks like graphically that wouldn't be the case, but out of necessity you have to do it ordered from most valuable to least valuable. It's just the way I'm helping you to understand whether or not to do the project is whether it's above or below the line. But if we added up all the total cost of the money and the borrowing costs, it would be clear that, and we'll see this when we get into Excel, when we move over to the computer classroom, that those last two projects, even if we tried to make it look like they were okay by having them first, really they're not okay. Yeah.
you do project C first, you're going to get more money from A.
Okay, so you're saying that the width of it means that there's more profit there because it's a big project instead of a small project, right?
You borrow more money and also you pay the interest maybe.
Yeah. So if you could only do one project, you're saying project C is the best if you only do one, right? Yeah. And I agree. If you can only do one project, it's better to have $2 million earning 26% return than to have $600,000 earning 35% return. So that's a true observation. In our case, we're going to borrow as much money as we can as long as we have something good to do with it. As long as we can put the money to work at greater than the MARR. Other questions or observations? Because I'm glad you've made some excellent points, and I'm glad that we're putting it out there. This is an example of, like I'll show you a picture like this on a quiz or an exam, and I'll say, explain this picture. And then what you should do is tell a story of what it means. You know, what is the interpretation of the line? What is the meaning of the width of it? You know, the vertical axis, what is that saying? Why are these two shaded differently? You know, so conceptual understanding can sometimes just be interpreting a picture and understanding what it all means. Yeah? It looks like it's the same. So this edge is on the same as the line. So the borrowing cost is 16%. And so it's not below the line, it's equal to the line. And so it's like the borrowing cost is 16% and the return is 16%. So why do you think they're saying reject? It's pointless. You can do the project, but you won't make any money. You won't lose money, but you won't make money. But maybe you'll be stressed out because now you have too many projects to keep track of. Yeah. So one of the unique things about C is because it's so wide, that means you're investing a lot of money in it. And so the profit is actually the area below this line until the blue line. And so look at the area, you know, area under the curve. So look at the area underneath here until the blue line because that represents your profit. And so the total area of project C's profit is bigger than the area of project A's profit. So maybe if you can only do one, it's better to earn 26% on $2 million than it is to earn the higher rate of return on a smaller amount. And in engineering economy, what they call that, when that's the case, is a mutually exclusive alternative. But these are not exclusive. You can do more than one project in this case. You can do safety training and buy equipment and also do other things as well. But sometimes, if you're buying paving equipment, you can't buy 3 different kinds of pavers. You only need one, and so that would be an example of a mutually exclusive alternative. Here they're not exclusive. Oh, okay. Yeah, so let's see, what if project C wasn't possible? If it's no longer an option, then you would shift all of these to the left. Now it's still in descending order. That's the important thing that we must do, is put it in order of highest return to lowest return. But if project C is no longer possible, then what that would do is it would make F and G so that now it's in these positions, and I think it would be still underneath the blue line. I'm sorry, the blue line would be underneath the rates of return, and so that would maybe make those projects more attractive because our borrowing costs would be lower. All right, so this term, MARR, M-A-R-R, we're going to see it a lot this semester. It means the minimum attractive rate of return. And we've just been looking at this as the example of if you're borrowing money from the bank. So a company is going to set as a policy, they never want to do a project where their borrowing costs are more expensive than the rate of return. So that would be a policy decision from the president of a company. But sometimes there's other factors in addition to the amount of money available for investment. That's one of the main ones, but it's not the only one. Sometimes it's related to how many projects they've got. So that if we go back to this, if it's only the borrowing, the MARR is 16%. But maybe it would be a combination of the borrowing costs, and maybe the president of the company says, I only want us to do 3 projects at any time. Because if we have more than 3 projects, we'll get confused and scattered, and it's not good. So if that was the case, then maybe the minimum attractive rate of return would be 26%. Because, 1, 2, 3, it's the rate of return for the 3rd most important project. So what this bulleted list is saying is, sometimes the number of projects will affect what you should choose as the MARR. And that can take into account opportunity cost. Opportunity cost means, of course, the next best thing that you could have been doing that you can't do if you are engaged in another activity. So if you spend money on construction equipment, you can't spend that same money on training, and so on. Risk may affect the percentage rate that they choose for the MARR, so that a project that's very risky, a company would want to have a much greater possible rate of return than a safe project. And there's also cost of administration, because some projects are very labor intensive and some projects are very simple. Investing money in a bank, for example, if you had 1 million dirhams and you take it to the bank, that's all you have to do is fill out some paperwork, put it in the bank, and then you start to earn your 1%. And so there's very little risk because banks are relatively stable, and the cost of administering a bank deposit is negligible. But let's say you take that same money and now you're going to buy property and you're the landlord, right? So if you're the landlord, there's more risk because maybe your tenants won't pay the rent. Maybe there's a risk that the tenant will leave and you have to advertise the vacancy for some time before you have a new tenant. That's another risk. And then the cost of administering. You're going to be busy every month checking on the utility bills. You're going to be coordinating repairs for the appliances, and so it's just a lot more hassle. So if you're taking that same amount of money, you'd want more than 1%, because you could have earned 1% at the bank. That's less risky and less time intensive. And so what we're saying here in bullet point 3 is that how much money you want on an investment is partly dependent on what you have to do in order to earn it. Some projects are very easy, some are a lot more challenging. Finally, and we'll get into bullet point 4 a lot through the semester, is that different types of organizations usually look for different rates of return. A private company usually wants more return than the government. Government agencies are investing in things like hospitals, and hospitals, just public services, don't return the same high rates of return as like a tech investment. Developing the next iPhone is going to be very, very profitable, whereas providing electricity to a small village far away, you'll be lucky if you break even on something like that. It's the right thing to do. It's good for society. It's good for the people in the village, but probably the profits will be a lot smaller. And so different types of organizations have different minimum attractive rates of return because of the types of organizations they are. Any questions about the concepts here? Okay, so where does the money come from when you want to buy a bulldozer, do safety training? The money can come from banks. We've already talked about that. And a bank investment is what's called debt financing. So debt financing is when you sign a contract and you have to repay a fixed amount of money to the people that you borrowed the money from. It may be a bank. Debt financing could be something that's called bonds or sukuk. Maybe you've heard of those. And that is a certain amount of money and you agree to a certain percentage of profit or a percentage of interest. Equity financing, by contrast, is where the person who gives you the money becomes your partner. It's sort of like they're buying a part of your business for the loan that they're giving you. And you don't necessarily promise them a specific interest rate. It's just that any profits you get, they are owning part of the profits. And so if you take money to the stock market and you buy shares in Apple, then that's equity. When you're owning stock, it's like you are a partial owner of the company. And if the company does well, you get a share of the profits. If the company does poorly, then you don't get any profits at all. And in fact, the value of your investment will decrease if the share price goes down. So those are the two main differences between equity and debt. And generally speaking, people consider debt financing like bonds, mortgages, those sorts of things as a safe investment. And equity is usually considered a little more risky, although the potential for higher returns exist with equity financing. And again, this is something that we'll come back to, especially when we're talking about the project. We'll come back and address different types of financing again, but you understand the broad strokes now. So a project is justified. You should do the project if ROR stands for rate of return. So the rate of return that you are getting for starting some new element of a company, some new investment, should always be greater than or equal to the MARR, minimum acceptable rate of return. And that's like the policy that your organization has. And that should always be greater than the weighted average cost of capital. And cost of capital is how much you have to pay other people to get the money you're using. And so this is like the logical rule for yes or no on certain projects. I could give you this list of projects and you could tell me yes or no for all of them based on that criteria, that the rate of return should be greater than the MARR. So here our MARR is 16%. So you can see which ones are greater than the MARR and say yes to them. All right. So finally, let's just delve into some more specific definitions of the opportunity cost, and then I'm going to give you the in-class exercise for today. One definition for the opportunity cost is the value of the second best option. It's the thing that you can't invest in because you already spent your money on something else. Another way of looking at it is for all of the projects that you didn't do because you didn't have enough money, it's the largest rate of return for that list of projects that you couldn't do. So that's the opportunity cost. So let's say that we've got two different projects. We've got project A that we didn't do, and project A would return 13% to us. Project B will give us a return of 15%. And so if we have these two projects and they both cost the same amount of money, then we'll choose the one that has the highest rate of return. So we'll do option B, which is higher than the MARR, so that's good. That's a thumbs up, yes, do the project. But what it means is we ran out of money. We would like to have done both of these. We couldn't do project A because we didn't have enough money, so our opportunity cost for choosing B instead of A is the 13% we didn't get for not doing project A. So it's too bad we didn't have more money because we had another good project, but in this case we only did the one. So that's an illustration of opportunity cost. It's 13% for this description. So that's the technical definition, like the quantitative definition for opportunity cost. And I've already told you a qualitative description of opportunity cost. So if we're setting aside the numbers and we're just thinking in terms of definitions, the opportunity cost to eating at Aruz Damascus, you met my cousin last time, right? So he said that this visit was all about meals, and in between the meals was just waiting until the next meal. That's how much he liked the food. So in the end, when he started to become acquainted with the restaurants, he wanted to go to Aruz Damascus, but he also wanted to go to Karachi Darbar. He also wanted to go to Nayab Handi. Like there's so many good places to eat. So you can only choose one. So the opportunity cost of doing one thing is all the other things that you could have been doing. So that's sort of the qualitative description for opportunity cost. All right, here is today's in-class exercise. I've already told you that sometimes I'm going to give you unfamiliar information and you're just going to have to figure it out. Now, of course, that's the case on this in-class exercise. We'll talk about it, but I'd like you to take a look at this one. For number 2 is a little bit strange. I'm showing you something you've never seen before on question 2. I'd like you to try and figure it out, and of course we'll talk about it once you've had some time to work on it and collaborate with your classmates. Okay. I think most of you will be able to figure it out, though, even though it's unfamiliar. There you go. Yeah. Okay. One more? Sleeping? It changes for everyone. Maybe it's going to the beach, right? Or it could be having a job. If you, Okay, so problem 1, opportunity cost. Maybe some of you had to quit a job to be at the university, so for maybe some of you, you could have worked a job and earned money. For some people, though, if they weren't in the university, all they would be doing maybe is watching television. So that opportunity cost is lower, right? And so the opportunity cost, remember, is the value of the second best option that you couldn't do because of what you did do. So if you're here, you can't be sleeping. If you're here, you can't be working in the shop. So whatever it is, the best thing that you could have been doing besides being here. All right. Question 2. So you've probably never seen bond data before. That's what this is. I copied this off of Bloomberg.com. It's a website that says what is the average cost of borrowing for different types of companies. And so you can see that a company that is AAA, AAA, only has to pay 1.94% when they borrow money for 5 years. But a AA company has to pay more. They have to pay 2.22%. So what does that tell you between a AA company and a AAA company? Okay, so a AAA company is somehow more stable. Maybe they've been around longer. They're considered a safer investment than AA, because whoever it is that's loaning the money wants more money for a AA than they do a AAA. And then a single A company, they're even more risky. And that's why if a single A company wants money for 5 years, they have to pay 2.51%. All right, so that's the difference in ratings. What about the timeline? Why is it that to borrow money for 10 years, a single A has to pay 3.5, whereas they only had to pay 2.51 for a 5-year? Yeah, the longer term, just the more things that could go wrong. You know, longer time horizon is more risk of default, more risk of inflation. There's just, you want a higher return for the longer amount of time you're tying up the money. So all you need to do here is that comparison. Is the rate of return greater than the cost of capital? So for option A, the rate of return 9%, the cost of capital for our AA company for 5 years, 2.2. So yes, let's do project A because we're earning more than we're paying. But then option B, the computer hardware, we can repay that loan in 2 years, but it's only giving us a 1% return. So why do we reject it? We're a AA company, we pay 1.32%. So if we borrow that money for the computers, we're going to lose money on that. So we should reject it because the cost of capital is greater than the rate of return. And it's the same pattern for the rest of them. Any questions about number 2? Okay, let's look at question 3. Think about it. What if you were the bank? If you were the bank manager, you'd want to know a lot of information about any company that you are giving a loan to. You'd want to know who are their customers. You'd want to know what projects do they have in the future. You'd want to know, are their employees happy? Because if the most talented, trained employees are leaving the company, that's going to hurt the company and their ability to earn money in the future. So it's just some of the factors. This isn't the only factors that are listed here. You probably thought of some good ideas that aren't listed that you'd want to know about. But that just gives you an idea of what is risk. Because we say, risk. A company is more risky than you want a greater return. But specifically, I want you to think about what are some of the risk factors that would lead to a higher rate of return that you'd want when making a loan. All right, that last one, that's a lot of words. Problem 4 has a lot of words there. So let's just dive right in. You have to raise 220 million dirhams to fund a project. Of the money you're going to borrow, 25% comes from a bank loan, and you're paying the bank 6.5%. 45% of the money you need will come from corporate bonds, and the people you're buying the bonds from want 4.5%. And the rest of the money you need to raise, which I guess the remaining percentage is 30%, you're going to get by selling a preferred stock. So the money the people who buy the preferred stock, you have to pay them 7.8% return. So weighted average cost of capital is just find the average of these different percentages that you're going to be paying out. It actually, you don't have to take the 220 million into account. I mean, you could calculate how much you're getting from each source, but what we're looking for is the weighted average of the cost of borrowing. And the reason, why do we want this percentage, is that this percentage of 5.99% is what we would keep in the back of our mind when we think about yes or no to the projects that we're going to spend this money on. If we're going to take this $220 million and the best thing we can find to spend it on is a project that only returns 4%, then we shouldn't take the loan to begin with because our weighted cost of capital is greater than that. So, all right.
So what's the weighted average?
The weighted average is just the definition of what the weighted average cost of capital is, how much it costs to borrow money from all of the sources together. That's it for today. Remember that coming up next, Tuesday has a homework due, Thursday has a quiz. See you then.